Welcome to Rich Dad Stockcast with Andy Tanner. Today we're going to learn a little something special. We're going to learn about the credit bubble. And man, I'm really hoping Andy helps us take advantage of this because I think it's indisputed that it does exist. Before we get too deep in that, I want you to hit the description button and go get Andy's free course. He has a free course on how to make money in a down market. And I think, and Andy will have to clarify this, I think when the credit happens, the credit bubble pops, we're going to find ourselves in a down market. And I think that's why Andy's choosing to give this gift at this time, but we will find out while we're waiting for Andy to talk, because I'm not going to let him. Make sure to write comments, read the description. What else am I saying? Subscribe. And this is financial education.
Yep.
Not financial advice. So yeah, when we talk about how to make money in a down market, we're teaching. We're not telling you what to do. We're never going to tell you what stocks to buy. We're just going to have Andy be the teacher. So
that
Andy,
sounds good to me. Yes, sir.
First of all, thanks for the course. I really appreciate that. In every episode you give a related free web training. I just think that's really cool, so that people can kind of get their mind going and then go somewhere to get it deeper. So just right off the bat, thank you. But let's talk about this credit bubble, because I just read in Forbes magazine some of the biggest big shots, in stock trading and hedge fund. They're saying this is going to happen. Like, there's no way it can't. You feel that?
Yeah. I mean, this discussion is something I get into on a weekly basis. My team and I look at this all the time, and the question is not. I mean, let's put this to bed. The question is not, will there be a collapse? Will there be a problem? Absolutely, there will be, in my mind. I mean, this is completely clear to me. It's completely unsustainable. It's completely unavoidable. So you can put to bed the idea that we're going to have a crash. There's no question. 100% in my view. 100%. The question that I don't have an answer to, and no one really does, Munger doesn't know, Buffett doesn't know, they've said as much, is we don't know when. We don't know the timing. The way Munger says it is, who knows how long money printing can last? Who knows how long it can last? We just don't know how long. We know it can't go forever, but we don't know how long it can last. So as you look at these numbers, it's kind of like looking at a balloon and watching it get bigger and bigger and bigger and bigger. And you just don't know, you're like, wow, I can't believe this is getting any bigger. It hasn't popped yet, but you really can't tell when it's going to and how long it'll hold out. And
So
that's the big issue.
let me dig in here. We're talking consumer credit bubble. You just mentioned printing money, so federal credit bubble. How related are these?
In the Forbes article, I browsed through it, as you sent it to me. It talked about all three levels, right? It talked about consumer debt, talked about corporate debt, talked about government debt. All three of those are there. And it's rough right now. Right now, even the new borrowing is tougher. The Fed is in a hell of a mess because they have to pull so many levers. They have to figure out how to balance one thing each other, employment and price stability and rates, and they're trying to juggle all this. And right now, when they pull levers, it's tough. For example, we had all this this borrowed money at low rates.
Mm-hmm.
And then all of a sudden you have bonds that are orders of magnitude at higher rates. And there's something we call mark to market. If I have a bond that pays 1% and I want to sell that bond because I have a run on my bank, right? People want their cash out of my bank, like Silicon Valley Bank. And now the mark to market, let's say that there's now 5% interest. The value of my bonds, or who wants to buy my bond at 1% when you can get fresh new ones at 5%? So that's why when rates go up, bond values drop. And, there's all kinds of problems with this. But regardless of what the rate is, regardless of whether you borrowed at 1 or borrowed at 5 or borrowed at 4 or borrowed at 6, when you borrow money, you got to pay it back. and old Buffett, he says it this way. He goes, when the tide goes out, now you see who's swimming naked. And the idea of leverage is attractive because leverage lets you do a lot with a little. Leverage is an accelerator, but when it's misused, overused, misjudged, man, it can tear you up. So, yeah, there's tremendous amounts of money. What will probably happen, though, that these guys don't mention in the article, my question is how many times can the Fed come to the rescue before the Fed can't come to the rescue? That's my
Right.
question. Because every time you have toxic debt or toxic assets, the Fed will provide liquidity, the Fed will loan even more money, the Fed will buy some of this crappy debt to keep it going. And how many
Well,
times, how far do you get before you're too big to bail? So that's my thought.
that's kind of my question. Like, so if the credit bubble pops, that's terrible, right? Terrifying. Except that who cares? The Fed's going to come in, kick in more money. That makes the markets thrilled and happy. So then stock prices go up. So
Yeah,
I guess one, what's
the
the big
bubble
deal?
gets bigger.
Two, yeah, that's the thing is it's just going to grow on top of itself. So isn't it good if you're a stock investor?
Well, it's great. Well, it depends. I mean, I love a bubble because to me, it puts everything on sale. So let's say I'm not the person that's over levered. Let's say I'm the person like Buffett that has cash. When things deflate, the dollar becomes more valuable because you can buy more stuff with it. So you have different people preparing for this in different ways. For example, some guys like Burry are buying put options, betting on the down move, right?
Mhm.
That's more dangerous because, as I said, you don't know where the down move is. So if you get the timing wrong, like if you look at the movie The Big Short and Christian Bale's playing his drums, right? Playing that character, he's freaking out because his timing, it's supposed to happen and it wasn't happening. Remember that part of the movie? He's like,
I
how
do.
can this not be happening? All these things are all these rates are adjusting. The numbers aren't. It's not happening. And then at the 11th hour, the drama was it happened. How many people bet before that saying Burry looked like a genius because he got the timing right? There were people probably in that same short position that got their butts kicked because it didn't happen soon enough, and there were other people who might have been set up for later that didn't work well. So when you get the timing right, hindsight makes you look like a genius,
Right.
but you may or may not have been a genius. You might have just right time and got it right. Who knows? Buffett is taking a different approach. Buffett, he's amassing cash. I think he's up to 140, 150 billion in cash. Now, why would you hold cash? Robert always says, why would you ever save money when it's losing value?
Right.
Well, you'd save money if you think things are going to deflate and you want to buy the world, right? You want to buy it all. So when there's a big crash, that's when a guy like Buffett and Munger, after a crash, that'd be more my style. The way you could do it however you want. You could time it and try to make money on the downside. You could keep your dry powder, wait for the downside, and then pounce. And that's the better bet, or it's the safer bet because you don't have to get the timing right. You just have to wait. When it happens, you're ready. So Burry is kind of taking a predictive stance. He's predicting that it's soon. So he has this big bearish position, right? This big put position. Buffett's saying, I don't know what the timing is, but I'm going to be ready when it happens, right? There's no way you're going to keep 140 billion in cash if you don't think there's not going to be some bargains coming up. And at least that's my thought.
But if you did it Buffett style, and this year alone, he would have lost 6% of that $1 billion because it's just sitting there while the dollar devalues and inflation hits.
Very true. Very true. But you got to figure on the other side of his ledger, how many assets did he have that have blown way past 6%? So, he's making a lot more money on the equity side of his ledger than on the cash side, right? I mean, and all those equities are just creating more cash anyway. So he's not hurting at all. I mean, they've had an incredible quarter there at Berkshire Hathaway, incredible. So he's not hurting one bit because he's got enough on. He's kind of got like a seesaw there, doesn't he? And as long as that's why he says cash flow is most important because whatever happens to his net worth as that fluctuates, well, who cares? He's got a cash cow coming in. And when these things fall, I'd say mark my words on this one, he'll pounce. So that's kind of the approach I take. Is consumers love Black Friday. It's coming up, right? Consumers
Right.
can't wait to spend their money in
Right.
Black Friday. They've got their money saved up. They're waiting for that sale, and they're going to pounce on those Black Friday sales, right? You're going to pounce on those. I like Black Swan because when you have a Black Swan event, the assets get cheap. And so Black Friday is about cheap doodads. Black Swan is about cheap assets. The problem is Black Friday has a date on the calendar when it is, and Black
Right.
Swan, well, it just hits you when you're not looking. So that's the big difference. But that debt
So
thing is real, man. In the article, those are real debts.
so we're talking about the examples used are billionaires, right? So sometimes I'll hear what Warren Buffett does or Soros, and I just feel it doesn't apply to me. So can we bring it down to
Well, let's
a
bring it down to Andy's
illustration?
level. I haven't hit $1
Bring
billion,
it down to Greg's level.
so yeah, I haven't hit $1 billion, but to me, I like copying Buffett. I mean, I don't have aspirations to have, $100 billion in my life. What I have aspirations to do is have a legacy, right? Build wealth, take care of my family, be out of the rat race, all that type of stuff. That's the happiness thing. Um, I think it's the same for you and I. I own many of the same stocks. I own Coca-Cola, I own Berkshire, I own Coca-Cola, I own Kraft Heinz, I own a lot of the same stuff that Buffett owns. Um, I just own less of it than he does. So really, one of the things I often say about stocks is it's scalable. You can own one share or you can own 1 million shares. It's very, very scalable. If you go into real estate, what's your lowest entry level? Probably like a trailer house or something, mobile home, probably a mobile home or something like that, or maybe like a storage unit or something. I don't know, but it's a significant investment. Shoot, if you're California and you have a garage, you got $1 million house now. So $1 million is, what's $1 million now? I never thought in my life I'd look at $1 million and say, well, that's not very much money. If a person wins $1 million in the lottery now, they're not set up for life anymore. You got to have more
Right.
than that to live. You buy a house in California, half house in California with $1 million, right? So yeah, I think it's scalable, Greg. I think I certainly want to have my dry powder ready too. So when this comes, what's really cool is where someone like Robert and even more like Kenny would be in a better situation. Kenny, his access is to other people's money.
Mhm.
So when all the investors that have dry powder fall, the price of the real estate falls, Kenny doesn't even need to have the money. He just calls up all his guys that have money, thousands of them, and they say, "Yeah, let's pounce. Let's buy some real estate." And Kenny says, "All right, give me your money. Let's do it." So having access to cash when it falls is your bigger play, or you can be more aggressive like Burry and actually try to make money on the move. That's a tougher one to do because I don't know when it's going to fall. I've been a perma bear. Like it's funny, Greg. If you look at my positions, I'm hugely bullish. There's this fancy jargon. Oh, let's get in trouble and talk about jargon. There's something called your delta, which means change, right?
Mhm.
How
Mhm.
much do you make or lose with the change in prices? I'm delta positive. In other words, I have all these stocks, these businesses that I own shares of. I want them to go up. Most importantly, I want the cash flow. But I have so many, I'm exposed to a crash. So I would need to know how to manage that. And so my approach would be managing it not opportunistically, but defensively,
Mhm.
and then being able to pounce once we get closer to a bottom in a crash. And there's lots of ways to determine that, and there's a lot of ways to hedge. I would buy insurance. That's why I hate freaking 401ks. There's a rant for you.
No
Freaking
kidding. No.
401ks. Those 401k guys are toast. They're screwed because they don't have a way to manage this. What does a 401k guy do? He's got no dry powder because it's all in 401k. Doesn't know how to hedge it, doesn't know how to use an option to hedge it to play defense in a drop, right? I mean, it's weird. I played offense and defense in COVID. The one stock I bought as we were going into COVID was I bought a few, not a lot, a few hundred shares of like 500 shares of ExxonMobil
Mhm.
because it hit 55. That was support. So I own this at 55. Then coronavirus hits. I thought, man, this thing could go to the basement. So I bought some put options to protect me, fell about $17, sold my puts, took the money, bought more stocks, and then let it come back up. So I got to keep my shares. I got defensive on that move. It was nice. And that's kind of how I think I would do the same thing. If we start to have trouble, those put options would be expensive, but they'll be worth buying. And we practice this every week in our mentor club, by the way. But that's an important point, Greg, is like you can't put your seatbelt on during the wreck, right?
Right.
And the only way you're really going to get good at anything is through practice. So in the mentor club, we practice on smaller moves all the time. And we teach people how to understand how much insurance they would need. Often we get the insurance to pay for itself. And we get what we would eventually call risk-free insurance. Eventually we could get there often. And we practice this every week to say, okay, how would we position if the big one hit? And so we want to be prepared for that. And I'll tell you that knowledge will save a lot of people when the big bust comes.
Okay, so we're going to go to break. Before we do, everybody go to the descriptions, get Andy's free course. But Andy, when we get back, what I'm going to do is I'm going to ask you a really simple question because I need it dumbed down for Greg here. I'm going to say, Andy, give me the 4 steps you're going to do knowing the credit bubble is going to crash. And I just want to hear your 3, 4 steps.
4 steps? Oh,
3, 4, 5, however, whatever the number is. All right.
Okay.
Because I just want you to dumb it down for me so I have a better idea of what Andy Tanner would do. All right. We'll do that. We're gonna get back
That's easy. That's easy. Okay.
Welcome back to Rich Dad's Stockcast with Andy Tanner. I got a couple things I need to go over here. You can listen to this show anytime, anywhere on iTunes, Android. You can go to richdad.com and go under the show tabs and get this. Robert always likes to say a big part of learning is repetition. And I like to say, since Andy has so much knowledge that this definitely requires repetition. At the same time, it might be better to take his web training that's in the description below, because not only are you going to get a repetition, a little bit of what we're learning here, but a lot better detail, a lot more strategic or action items, if that's fair to say, Andy.
Yeah, that's fair.
So, Andy, I promised that when we came back from break, you would make this so dumb that Greg could understand it. So
that your self-deprecation kills me.
I'm telling you,
you don't give yourself credit.
Being on the same show with you, I feel like an idiot. So, Andy, the credit bubble is going to pop. Yeah. What are the 3 to 4 steps, however many steps that you're going to take? 1, 2, 3, 4 to 1. Let's say protect yourself, but 2 to profit from it.
Well, I don't think we need 4 steps. I don't think it's that tough. I'll ask you this. Do you have insurance on your house?
Yes.
Okay, why?
The possibility it could break or burn down
So insurance gives you leverage. In other words, you pay this small amount, and when the big fire comes, that policy explodes in value, doesn't it?
Right.
It's not worth anything right now because your house isn't on fire. It's just a liability, but it's a small liability. So insurance is a leverage play. You get to take care of a whole bunch with a little bit. In the book, Unfair Advantage, Robert's book, Unfair Advantage, he was kind enough to invite me to write just a small amount about this. And the first step would be insurance, right? So as I mentioned, the Mentor Club, we know how to buy insurance, which in the class, I'm going to take you through Mark Cuban's play. I think that's the one I use. Is Mark Cuban? He sold his company broadcast.com for, I think, $5.7 billion in Yahoo stock. But the Yahoo stock, that's going to crash, right? I mean, the .com bubble took it out, went from like $100 to like $5, lost 95% of its value. So right. How is Cuban still a billionaire? Well, he'll tell you he bought insurance. What was interesting is he had $25 million cash from his business just sitting there. And when he sold his company for $5.7 billion, he spent every dime of that in insurance, every dime he had to protect it. And because he had a 6-month vesting period before he could sell. And so he lost $25 million. He lost the whole thing because it didn't crash. But the moment that he could sell, he kept it going. And when it did crash, he made a fortune. In fact, I've heard in articles he was actually overinsured. So he had like when Eddie Murphy breaks the vase in Trading Places,
Right.
and they say, well, I believe we paid $15,000 for that vase, but I believe we estimated it for the insurance company at $30,000 or whatever it was. So step one, to make it easy, do what you do with your house, learn to buy some insurance, learn to have a hedge, learn to take a small amount of money and leverage it to protect a large amount of money. Is that simple enough?
Yes
Take a
and no.
small amount of money, invest it to protect a large amount of money.
So the assumption being here, we already have stocks. So this step is perfect if Greg already has stocks. What if Greg doesn't?
Well, then you don't need to worry. I mean, if Greg
Well,
doesn't have any
I
stocks,
want to make some money on this bubble.
well, you asked what I would do. You didn't ask what you would do.
All right, what would Greg do?
Greg, you would, if you didn't have any money, I wouldn't announce it. I know you have money, dude.
Steal anything from me, so
yeah, I know you have money. No, I mean, then you'd be the more Burry, and that's not what I would do. I think, Burry is in a different situation. I think he's more sophisticated. I don't think he has all his eggs in that basket, even though he has a lot of them. And I just wouldn't recommend that. I mean, if you want to be opportunistic, like we said in the first half of the show, you have a Buffett approach and you have this timing approach. I think the preparing for it is more important than the timing of it. I don't know how to time it, something that big. Now, what you could do is you could learn technical analysis like my friend Noah Davidson. And the way you could speculate, it's pretty risky, is once you see something start breaking technical levels, right? You'd never know how far down it's going to go. But let's say you break a 200-day pretty hard, pretty fast. Well, then maybe you short some S&P. You want to be, I shouldn't even say this on the show, man. This is like 50 to 1 leverage. This is 50 to 1 leverage, and someone's going to get their face kicked in and blame me.
Here, let me help you. This is not financial advice.
Yeah, thank you. I shouldn't even say this.
And he's only educating on possible things.
Yeah. See, Greg reels me into this stuff because he wants the big, exciting, craziness. But if you took like some S&P future contracts, 50 to 1 leverage, you take a short position on those at a technical level, absolutely got to have a stop on this. If it bounces back up, you got to have a stop. And that's where things like average true range and not getting whipsawed. I mean, it's hard to do this. It's hard. But if you caught it and it did fall, you would become insanely wealthy if it kept falling after that position. Now, I wouldn't do that. I've used those as a hedge to kind of balance a seesaw between what I own and get what we call delta neutral. And that's what I would do. I would get delta neutral and wait the thing out. Just look to preserve what I got. Look to preserve what I got, get delta neutral, let all the dust settle. And when the dust settles and prices are low, that would be the second phase, right? Protect yourself with insurance would be the first answer, right? Make a small investment at a leveraged investment to protect yourself, and then have a little bit of dry powder. And I would look to pounce. I would look for deals. And the way I would pick those up is the same way I did it in coronavirus. I'd sell puts to get paid to buy low. And I would just make promises. Let's say it falls down. The way I usually do is half and half. I'll buy half outright and say, I want the position. I don't want to miss it going up. So I buy it. And then I also sell some puts at another level below that in case I can get some more even cheaper and get paid to do it. So either way, that subsidizes the first purchase. If it goes even further, I'm happy it subsidizes that one as well. So that's one, too. Buy some, that's kind of weird. Buy some puts to protect yourself on the way down, sell some puts to get paid to buy them, and then let them go up. And that's 1-2 punch, man. That would be it. Not too tough.
So to go, well, let's see, puts are just no worries. Buying and selling puts, is that going to be in the course? What is it called? How to make money in a down market? I'm not going to talk
about. I won't talk much about selling them. I think I might touch on it, but the most important thing we'll talk about is how you make money on the way down if someone wants to speculate that way. And more importantly, how you protect yourself on the way down, because you're still making money on the way down to compensate for what you might be losing on the other side. Yeah,
Gotcha.
you don't want to sell your stocks. You don't want to sell your stocks. When people say, "Why don't you just sell them?" Sell them. Well, then you've got capital gain issues. You got tax. You got all this stuff. Just protect it. Protect it. Don't sell it. And it's too hard to time it. It's just too hard to time it. I'm not a good enough technical analyst to predict the future and see that timing. That's too hard.
When I heard you talking about the Buffett strategy, I did kind of feel like he was saying, sell everything, put your money on the side,
No.
and then wait for the crash and buy. That's
No,
not
no, Buffett would never sell his. I mean, the capital gain he'd have on Coca-Cola would be nuts, right? I mean, I think his average price for Coke is like $3.25 a share. So, you really want to do that and sell your stock when it's at like 60 or whatever it's at now. That's crazy. He's not going to do that. What I'm saying is have some dry powder. Have a little cash, have a little. I really like the liquidity of bonds. You could put some money in bonds. They're paying 4.75 for a 10-year or something like that right now. I don't know what it is, but they're liquid. That'd be a place to store kind of a cash equivalent, I guess you might call that. Yeah, just have some dry powder ready, because they'll be bargains. Picture Buffett as a seesaw, right? He's got cash on one hand, equities on the other.
Mhm.
So if the equities fall, the value of that cash is really nice. When the equities rise, you can't buy as much with that cash, but the seesaw works because it always balances each other out. I think it's a smart position. I think they believe there will be a crash. You wouldn't hold that much cash if you didn't. And I think they're just going to pounce because they've done it so many times. Like in '08, they bought some warrants and they got some warrants with was a Bank of America, I think. And he just cleaned house. I mean, he just cleaned house on that trade, and picked up a great bank for very, very little because he was in a position to buy when it was down. And I think he's got set up for the same thing.
Gotcha. That is
Yep.
actually similar. My wife and I, we kind of followed your lead, and we meet once a week to go over our numbers. And so
Sweet.
we just sold a few of our assets, about 20%. We sold them just to have the cash because, much like you said, we're waiting for that credit to the bubble to pop, and then we want to pounce.
Yeah.
So we didn't get rid of
When it
everything.
does,
Under
yeah,
20.
when it does, having some cash is king when you're depressive, right? If you look at the 1929 crash, if you had cash, look at what you could have bought, right? And
Mhm.
cash is hard to come by. No one has a job. Everyone's trying to save it. Prices are plummeting because, well, cash is cash, right? And they're trying to get some. So when they want the cash really bad, they'll drop their prices to try to get cash rather than a product, right?
Right.
So prices fall, and when prices fall, cash is king, man. Not debt. Cash is king.
Scary.
In inflation, debt is king because you're borrowing high and paying back at less.
Is it too, I don't want to say it's too strongly, but so right now I'm prepared for recession, you know, deflation. But what I really want to do is pounce real fast. I'm getting my own coaching from Andy. Sorry, everybody. Pounce real fast and then go straight into the mindset that inflation is going to hit again and get into debt.
Inflation we might not even have the depressive state. We might not have the depression. They're talking about a crash. Fed could really try to prevent that because it's almost like since Greenspan, you know, to Powell, and everywhere in between, Bernanke, Yellen, they've all decided we're not like everyone looks at the 1929 as a Fed mistake that they could have
Mhm.
prevented that by printing money and providing liquidity. So none of them are willing to do those high unemployments. None of them are willing to do that. So you could actually hyperinflate just as easy. I think that's the way Robert's betting is you could hyperinflate. Well, if you do that, you want to have assets. You don't want to have cash. That's why I think having a little bit of both
Right,
covers
right.
you both ways, right? I don't. For me,
Gotcha.
I don't think it's about predicting which one it is. I think it's being prepared for both. certainly the guy that predicts and gets it right makes more money. It's that simple. If you predict, you get it right, you're going to make more money. All your eggs in that basket, boom. But me, since I don't know the future, I think preparing equally for inflation and deflation. That's the two ways it goes. Have an ability to do both, and as long as you're cash flowing, get out of the rat race with your cash flow, and then because we're really talking about directional stuff, right?
Yeah.
And that's why I like cash flow better. Look, don't get caught up in the direction as much as your cash flow. They're going to sell Coca. People are going to buy Coca-Cola in a depression or in an expansion, inflation. They're just going to buy Coca-Cola. They're going to buy it. They like it. It's got caffeine. We're all addicted to it. People are going to buy their iPhone, right? They're going to pay their AT&T bill. So you want to have cash flow above all that. All this change of direction stuff is more capital gain mentality. So that's why I'd rather protect than try to be opportunistic. I'd rather be opportunistic on my cash flow. No one ever said, I got to do the golden goose every week, right? No one ever said, let's buy this golden goose based on the price of the goose. Maybe I can sell it next week for double, or maybe, oh my gosh, I better sell my goose because it's going to be worth half. That's not the mentality of the direction up or down the goose. It's like, am I going to get eggs fairly consistently? And I'll have more eggs some years and less eggs others, but it's cash flow that I'm looking for. That's why protecting assets, to me, I think is more prudent than speculating tremendously. Now, if you're the Big Short and you get it right, they'll make a movie about you. Great. But I'm content with just cash flow and being prepared.
Yeah.
Going Boy Scout, be prepared.
You've always said one of the beautiful things about the stock market is you can make money when it goes up, when it goes down, and you can manage your risk. So, you just kind of
if you take a cat, like Warren Buffett said it in his 2021 letter or 2020 letter, and this was in coronavirus where everything was falling. He says, look, the most important number is operating earnings, right? Do you have companies that are operating? Are you giving value? And are they earning money? The most important thing in real estate are people paying rents. If they're paying rents, you're going to be fine. If they're not paying rents, you're kind of dead. That's simple.
Well, let's end it on that, because simple's king, baby. So, Andy,
simple.
Thanks again. Always. And everybody, go to the descriptions, grab Andy's course.
You can check that out.
Better detail. Greg's not.
And I give, and the reason I give those courses is pretty obvious. We hope people want to learn more and join us at the Cashflow Academy. And so it's a great idea to find out, what's our style of teaching? Do we really make this simple? And what specials are there on big courses that you can study over time? So it's fun stuff. It's good advertising.
There you go. All right, Andy, I'll see you next week.
All right, Greg. Thank you much. We'll see you.
Thank you, man. All right, bye.
Podcast is a presentation of Rich Dad Media Network.